Everyone talks about compound interest like it's some kind of secret hack that can change your life overnight. But when you actually start putting money to work, the experience feels nothing like that. You look at your account after 6 months, and the progress feels almost laughably small. A full year goes by, and the balance is barely budged. 2 years in, and you start questioning whether all those finance experts were feeding you a fantasy. At the same time, you see other people buying cars, taking trips, and enjoying life in the moment. Meanwhile, you're over here trying to be responsible by investing for a future that still feels forever away. That disconnect between what you imagined and what you're actually seeing creates a kind of mental friction that makes you want to quit. Here's the part nobody really explains about building wealth through compounding. It's supposed to feel like it isn't working. The same math that eventually helps people become wealthy is also what makes the first several years feel like a waste. Understanding why that happens, and more importantly, knowing when it starts to change, is what separates people who quit right before the payoff from people who actually build meaningful wealth. There's a framework called the 7-5-3-1 rule that explains not only why compounding feels painfully slow, but exactly when it starts to speed up and what you need to do so you're still around when that shift happens. Once you understand this framework, the way you think about investing changes completely, because you stop judging yourself by unrealistic short-term results and start recognizing the real path you're on. Let's walk through exactly how it works. The first number in the 7-5-3-1 rule is 7, and it stands for the minimum number of years you need to stay invested before compounding starts creating results that actually feel meaningful. This isn't just some random number. It's supported by nearly a century of market history and reflects a basic truth about how wealth is built. Think about what happens when you invest in a diversified portfolio, earning around 10% a year, which is close to the long-term historical average return of the S&P 500, going back to 1926. In your first year, a $10,000 investment grows to $11,000. That's $1,000 in gains, which sounds fine, until you realize you could have made that by picking up a few extra shifts at almost any job. The trade-off feels huge, because you passed on spending that $10,000 on things you actually wanted. And in return, all you got was $1,000 you still don't feel comfortable touching. In year 2, your $11,000 grows to about $12,100. Now you've made around $2,100 total, but it took 2 full years. Meanwhile, inflation has chipped away at some of that buying power, and the stuff you wanted 2 years earlier now costs more than it did when you began. Technically, the math is doing its job, but emotionally, it doesn't feel that way. By year 3, you're sitting at roughly $13,300. By year 4, around $14,600. By year 5, about $16,100. 5 years of discipline. 5 years of watching everyone else enjoy their money. 5 years of trusting a process that still hasn't delivered anything that feels life-changing. And you've made only about $6,000 on your original $10,000 investment. This is the exact point where most people give up. They look at 5 years of sacrifice and decide the payoff doesn't justify the emotional strain. They convince themselves compound interest must be something that works for other people. People who had more money at the start or got luckier with their picks. So they cash out and buy something real. Something they can enjoy today, and in doing that, they miss everything that comes next. Because here's what starts happening in years 6 and 7. The momentum begins. Your $16,000 turns into about $17,700 in year 6, then roughly $19,500 in year 7. You've almost doubled your initial investment, and even more important, you've crossed a mental threshold where the yearly gains begin to feel meaningful instead of tiny. But the real shift comes after year 7. From years 8 through 12, your account climbs from about $19,000 to roughly $31,000. From years 13 through 17, it jumps from $31,000 to around $50,000. By year 20, that original $10,000 has grown to about $67,000, with no additional contributions beyond the initial amount. The compounding curve isn't straight. It's exponential. And exponential curves are misleading because they look almost flat for a long stretch before they suddenly turn upward. The 7-year point is roughly where that bend starts becoming obvious, where your gains in a single year begin to outpace what you made during the first several years combined. Historical data lines up with this surprisingly well. If you look at rolling 7-year periods in the S&P 500, there has basically never been a stretch where investors ended with negative returns if they stayed invested the whole time. Short-term investing is gambling. 7-year investing is wealth building. The second number in the 7-5-3-1 rule is 5, and it explains why so many people still fail even after they understand the value of staying invested for the long haul. The 5 stands for the minimum number of investment categories you should spread your money across so you're actually capturing growth instead of just hoping you guessed right. Most new investors make one major mistake. They pile all their money into whatever has been hottest lately. Maybe they hear tech stocks are on fire, so they buy nothing but tech companies. Or maybe they read that small-cap value stocks outperform over time, so they go all in there. The issue isn't that those strategies can never work. The issue is that no single category stays on top through every market environment. And concentration exposes you to brutal losses at the exact time you can least handle them. The 5-category framework suggests dividing your investments across large-cap quality stocks, value-focused holdings, growth stocks bought at reasonable prices, mid- and small-cap opportunities, and international or global exposure. These 5 groups respond differently under different economic conditions, which means when one area struggles, another often helps offset it. That matters a lot for long-term investing, because the biggest threat to your wealth usually isn't the market itself. It's your own behavior when the market drops. If all your money is packed into one category, and that category falls 50%, you're much more likely to panic and sell at the worst possible time. If you're diversified across 5 categories, and your overall portfolio falls 20%, while some parts hold steady or even rise, you're far more likely to stay calm and stick with the plan. Diversification doesn't maximize returns in any single year. It maximizes the odds that you remain invested long enough for compounding to speed up. The average stock market return is around 10% per year, but the actual results swing wildly from one year to the next. The S&P 500 returned about 25% in 2024 and around 26% in 2023, after falling 18% in 2022. Individual categories moved even more dramatically. Diversification smooths those swings enough to help you stay invested through the volatility, which is what ultimately determines whether you capture the long-term average or bail out during temporary declines. The third number in the 7-5-3-1 rule is 3, and this may be the most important number of all, because it deals with the emotional reality of investing, not just the math. The 3 refers to 3 separate emotional phases that every investor goes through, and knowing them in advance can be the difference between surviving them and getting wrecked by them. The first emotional phase is disappointment. This happens when your investments produce returns that are technically positive, but still feel small compared to what you expected. You invested $10,000 expecting to feel richer, and instead, you made 7% or 8% during a year when your coworker's crypto position tripled. The returns are happening, but they don't feel impressive, and that emotional gap creates real disappointment. The second emotional phase is irritation. This happens when your portfolio seems stuck for long stretches, producing gains so small that you start wondering whether investing is even worth it. Maybe the market went nowhere for 18 months. Maybe your balanced portfolio returned 3%, while a single stock you didn't own gained 40%. The irritation phase makes you frustrated with the process, with the advisors who told you to do this, and with yourself for choosing the sensible route instead of swinging bigger. The third emotional phase is panic. This is the most dangerous phase, and it happens when your portfolio loses real value during a market decline. Panic doesn't feel like disappointment or irritation. It feels like you're watching your financial future disappear in real time. Every day brings uglier headlines. Every time you check your balance, it confirms your worst fears. The rational part of your mind knows markets recover, but the emotional part is yelling that this time is different, that you need to get out before everything is gone. The panic phase has destroyed more wealth than any crash in market history, because it pushes investors to sell at the worst possible moment and lock in losses that would have recovered if they had simply stayed put. The 2008 financial crisis, the 2020 pandemic crash, the 2022 bear market, each one caused huge numbers of investors to sell at the bottom, and then watch the market rebound to new highs months or years later. Market corrections of 10 to 20% happen almost every year. Larger declines of 30% or more show up about once a decade. These aren't unusual events. They're the expected price of earning long-term returns. Investors who truly accept that reality don't panic when corrections hit, because they've already made peace with the fact that temporary losses are part of the deal. The fourth and final number in the 7531 rule is 1, and it represents one simple commitment that can dramatically speed up wealth building. Increase your investment contributions by at least one meaningful step every single year. That could mean adding 10% more to your annual contributions whenever you get a raise, or just bumping up your monthly investment by a fixed dollar amount each year. The power of that yearly increase is hard to overstate. Think about two investors who both start putting away $500 a month at age 25. The first investor keeps contributing that same $500 for the next 30 years. The second investor increases their contribution by 10% each year. Both earn the same average annual return of 10%. After 30 years, the first investor has contributed $180,000 of their own money and built a portfolio worth around $1,100,000. That's a great outcome. They turned what they put in into more than 6 times that amount. But the second investor, who increased contributions by 10% every year, has contributed about $340,000 and built a portfolio worth roughly $3,200,000. That's almost triple the wealth from the same starting point, just by increasing contributions annually. That yearly increase does 2 things at the same time. First, it feeds more raw material into the compounding engine, which means more dollars get to ride that exponential growth curve. Second, it keeps your investing aligned with the way your income usually rises over the course of your career. If your contributions stay flat while your income goes up, you're actually investing a smaller percentage of what you make over time. The annual increase keeps your savings rate in step with your growing earning power. Now let me show you why all 4 of these numbers work together to create something stronger than any one strategy on its own. The 7-year minimum gives compounding enough time to start bending the curve upward. The 5-category diversification protects you from concentration risk and helps you stay invested through volatility. The 3 emotional phases prepare you mentally for the challenges that derail most investors. And the 1 annual increase speeds up your wealth building while tracking your income growth and helping offset inflation. Take away any one of those pieces, and the whole system gets much weaker. Stay invested for 7 years, but put everything into one category, and a bad sector rotation can erase years of progress. Diversify correctly, but quit after 3 years, and you'll never reach the acceleration phase. Stay invested and diversified, but never raise your contributions, and your wealth will grow more slowly than it could. Understand the emotional phases, but have no framework for dealing with them, and you'll know you're panicking while still not being able to stop yourself. Let's make this more concrete, with some real numbers that show what this framework looks like in practice. Imagine you're 25 years old, and you start investing $500 a month in a diversified portfolio built around the 5-category approach. You commit to staying invested for at least 7 years, knowing the early years will feel slow. You mentally prepare for the disappointment, irritation, and panic phases that will inevitably show up. And you commit to increasing your monthly contribution by 10% each year. By age 32, your 7-year point, you've invested around $60,000 of your own money, and your portfolio has grown to roughly $90,000. The progress still feels modest compared with the sacrifice, but the groundwork is there. By age 35, your portfolio has grown to about $150,000. By age 40, it's around $350,000. By age 45, you're getting close to $700,000. And by age 50, you've crossed the $1 million mark. Notice what happens to the yearly growth as time goes on. In the early years, your portfolio may grow by $5,000 or $10,000 in a year. By your 40s, it may be growing by $50,000 a year. By your early 50s, one strong year adds more than your entire portfolio was worth after 7 years of investing. That's the compounding acceleration everybody talks about, but not many people actually experience because they quit before they get there. The rule of 72 gives you another useful way to think about this acceleration. Divide 72 by your expected annual return, and you get the approximate number of years it takes for your money to double. At 10% returns, your money doubles about every 7.2 years. This helps explain why the first doubling feels so different from the ones that follow. If you start with $10,000, your first doubling takes you to $20,000, a gain of $10,000. Your second doubling takes you from $20,000 to $40,000, a gain of $20,000. Your third doubling takes you from $40,000 to $80,000, a gain of $40,000. Every doubling adds more actual dollars than the one before it, even though each doubling still takes about the same amount of time. By your fourth or fifth doubling, you're adding more money in one doubling period than your whole portfolio was worth after the second or third doubling. I also want to talk about something that keeps a lot of people from ever getting started, which is the feeling that they're already too late. Maybe you're 35 or 45 or even 55, and you haven't seriously started investing yet. The math of compounding can feel like it's working against you because you don't have 40 years to let it build. But here's the truth. Starting late is dramatically better than never starting. Even at 50, with 15 to 20 years before traditional retirement age, compounding can still make a meaningful difference in your wealth. The 7531 framework works no matter when you begin. The 7-year minimum horizon applies whether you're 25 or 55. The 5-category diversification becomes even more important when you have less time to recover from concentrated bets. The 3 emotional phases will still show up, and the 1 annual increase matters even more because you're trying to speed up progress with a shorter runway. The biggest mistake late starters make is deciding that since they can't get the perfect outcome, there's no point in trying at all. Later is still better. Less than ideal is still progress. Moving forward from a weaker starting point is still moving forward. The 7531 rule is not a guarantee of any exact result. Markets move, economic conditions shift, and people's circumstances vary widely. What it offers is a framework for thinking about wealth building that improves your odds of success by addressing the real reasons most people fail. Most people fail not because they couldn't earn strong enough returns, but because they gave up too soon. Most people fail not because diversification doesn't work, but because they concentrated in the wrong place at the wrong time. Most people fail not because they're emotionally fragile, but because they were never prepared for the normal emotional reactions that come with investing volatility. Most people fail not because they couldn't save more, but because they never built a system for increasing their savings rate over time. Here's what usually happens when you follow this framework and stick with it through the unavoidable challenges. The first 2 years feel like you're throwing money away. Years 3 and 4 feel like maybe it's working, just very slowly. Years 5 and 6 bring the first serious doubt. Shouldn't you have more by now? Then year 7 arrives, and you realize your annual gains are beginning to outpace your annual contributions. By year 10, your investment returns are creating more growth than your salary creates income. By year 15, you stop obsessively checking your accounts because the numbers are moving on their own. Somewhere around year 20, it hits you that you've built something real. Not because any single year was extraordinary, but because ordinary returns, compounded over ordinary stretches of time, create extraordinary outcomes. The tortoise beats the hare not with speed, but with steady forward movement. The people who build real, lasting wealth aren't the ones who found the perfect investment, timed the market flawlessly, or got lucky on some speculative bet. They're the ones who understood how compounding truly works, prepared themselves for the psychological challenges that derail most investors, and simply stayed invested long enough for the math to do what it promised. Compounding feels slow, until one day, it doesn't. The 7531 rule tells you exactly why it feels slow, exactly when it begins to accelerate, and exactly what you need to do to make sure you're still in the game when that moment arrives. The wealth you're building isn't obvious yet because you're still in the flat section of the exponential curve. But the curve is real, and if you stay invested long enough, you'll eventually experience the steep part yourself.